Welcome back to Insights Now. I'm David Kelly, Chief Global Strategist here at JP Morgan Asset Management. The 2024 presidential election is well underway and has already delivered a host of surprising twists and turns. Against a backdrop of relatively stable economic growth and quite impressive US stock market returns, the election adds a source of uncertainty for investors. Could the election outcome pose a risk to markets or certain sectors and asset classes? And in what can sometimes be a tense and polarizing time in society, how can investors navigate this uncertainty and invest in confidence this year? To help answer these questions, I'm excited to be joined by Stephanie Aliaga, a global market strategist here at JP Morgan Asset Management, who's helped spearhead our insights on the elections this year and has had many of these conversations with investors and financial advisors across the United States. So let's get started. Stephanie, welcome back to the show.
Hi, David. Thanks for having me.
You're welcome. We're recording this on July 31st, and a lot has already happened in the election season so far. Has what's happened so far, has that been having any impact on markets?
Well, for the most part, I think no. Now, this year has been a really strong year for investors, really coming after last year, right? Mm-hmm. But by the midpoint of this year, markets, the S&P 500, had already made 31 new all-time highs. Now, as we are today, that number is now at 38 new all-time highs, right? That, combined with expectations for a soft landing for the U.S. economy, the potential prospects of Fed easing this fall, all of that has led to some pretty healthy investor sentiment. In fact, the VIX, which measures stock market volatility, is at just 14 this year on average relative to 17 last year. Mm-hmm. So far, I think markets have taken the prospects of the elections, any uncertainty there, for the most part in stride. Now, in recent weeks, there's been even more headlines around the elections. There's been a lot of twists and turns. And with that, markets have paid a bit more closer attention, right? We've seen this rotation in the markets outside of some of those mega cap tech companies that have just been leading the way towards more value-oriented and small cap areas of the markets. Now, I will say, while the timing of this has kind of aligned with some of those catalysts on the political calendar, the bigger catalysts, I think, were really the macro. It was like the June CPI report, a change in the Fed tone. So some of that movement has been ascribed to markets pricing in the probability of a Trump victory and a Republican sweep. But we think that probably is a bit overstated. So now, betting markets have already kind of moved from that. And we're now more in a toss-up area between now Vice President Harris as the presumptive Democratic nominee or former President Trump. But even with, now it's a toss-up and compared to expectations for a red sweep, this rotation has really continued. Mm-hmm. So I think the market impact has been much more negligible, but we are now less than 100 days until the elections, mm-hmm. or just about 70 trading days. So perhaps this, continues to be a focus for the markets.
Is there anything that we can say in broad terms about what the impact on the market overall would be of a Trump victory versus a Harris victory?
Yeah, I think it's helpful to look at what we saw in the last two presidential elections. So if we think back to 2016, when Trump first won the presidency, that really took a lot of people by surprise, including the markets. Mm-hmm. And what we saw was a swift kind of repricing in the markets. Now, investors quickly moved away from, I think, initial fears around what a more protectionist administration would look like, to then embrace the prospects for lower corporate tax rates, right? The Tax Cut and Jobs Act, perhaps a more friendly regulatory environment. So all of that led to a bullish response in the markets and certain areas of the markets to perform better than others. Now, when Biden won in 2020, you had markets like the prospects for more fiscal spending with Build Back Better. But this was also 2020, right? And so markets were actually more dominated by any news around COVID vaccines, around the potential for a return to normal. That was a much stronger driving force for the markets than really whatever Biden was campaigning on outside of fiscal measures. Now, where are we today, right? And I think that is the big question on many investors' minds, like, what can we expect this November? Well, the macro environment is a much more benign one than the last two, election years that we've seen. And there really isn't a lot of room for additional tax cuts or any massive fiscal spending because we're not battling a pandemic, right? Now, kind of going back to that earlier point on, what we could potentially see if we had a Trump victory or a red sweep, maybe we see a more lax regulatory environment. But there are big question marks for investors about what the implications are of more strict tariff measures, protectionist measures, maybe an immigration crackdown. These are things that aren't really great for markets. And things like antitrust, which could be a big risk for the tech companies that have been dominating the markets, could really prevail under either a Democratic or Republican administration. Now, what could we see if the Democrats win in November? Well, presumptive nominee seems to be VP Harris, and maybe you see some more left-of-center policies, but it is very difficult to see a path for a Democratic sweep of Congress. The cards are just stacked against the Democrats in the Senate this year. And so what that means, well, likely means divided government, which is actually where we spend the majority of our time in. 61% of years on average are divided government years, right? And under that environment, we would expect that, political gridlock continues to be the norm. It's going to be really hard to get things passed. Maybe there's some things like certain tax cuts are allowed to expire for wealthier individuals. Maybe there's a little bit more fiscal spending in some areas. But by and large, we think under a divided government scenario, markets are just going to move on to focus on other things.
Interesting. Well, in some ways, when we talk about markets, we're thinking a lot about the stock market. Let's talk about the bond market. I mean, could the election mean for interest rates?
Yeah, that is another big question, I think, for investors this year. And we've seen in recent weeks with this rotation in the stock markets, we've also seen a steepening in the yield curve. Now, the timing of that is also aligned with some of these political headlines, right? So, but it's also been, I think, most driven by just expectations for Fed easing. That is really what's been helping bring front-end yields lower. But when it comes to the implications of elections and politics for rate markets, I think the conversation is really much more on the long end of the curve and on the sustainability or the lack thereof of our deficits, right? And that is something that investors have been taking a lot more focus on for good reason, right? The CBO recently updated their projections for the deficit, and they added about $2 trillion to their projections for the deficit over the next decade. That's a lot of Treasury supply. And we've just lost our biggest buyer of our debt, right? The Fed is no longer showing up to the auction window as much. So all of this supply does lead to perhaps, upward pressures on interest rates over the long term. But I think the other really key thing here is really it's not so much about who wins this November, but it is just that there are some things in U.S. politics that are starting to taint, I guess, the U.S. dollar or the lack of a term premium that we've really had to pay on our U.S. debt, just given that we are, the U.S. government and the full faith in our institutions to pay our bills. So these are things like the debt ceiling fiascos that we keep coming dangerously close to. It is things like perhaps imprudent fiscal spending and even just the chatter and the murmurs around Fed independence, right? All of these could have a toll. They've had a toll on, U.S. debt ratings. And so if these continue, maybe that means that we need to start paying just a little bit more on our debt over the next 10 years. And that means that rates over the long term will just be a little bit higher than historically.
Okay. So turning back to the stock market, are there particular sectors that you think could benefit from one outcome or another?
Yeah, and we get this question oftentimes. It's one of our favorite questions because it's kind of like a trick question, right? But, sector performance and political outcomes, right? I think uncertainty for investors can sometimes be really attractive because uncertainty creates opportunities, right? So oftentimes investors are thinking about, okay, depending on who is going to win in November, like what different policy agendas could lead to some sectors to underperform or outperform, and maybe that is an interesting trading strategy, right? it is an interesting conversation, and it is a very unreliable trading strategy because it is very difficult to, one, delineate, campaign promises, which are oftentimes much more robust than what ultimately gets passed, whittled down, bargained at on Congress, right, and then passed into law. That is very hard to kind of to delineate. Biden's Build Back Better is a really good example of that because it had to get whittled down quite significantly to the ultimate, IRA and, infrastructure bill that got passed in under his administration. But similarly, I mean, even if you just look at, this is my favorite example to tell, how traditional oil and gas performed under the Trump administration versus renewable energy stocks, right? And then you looked at that same performance under the Biden administration. If you had invested based on what those two presidents were campaigning on, were even real policy that they then enacted. So under Biden, for instance, you actually had a quite historic spending bill for spending around renewables and electric vehicle consumption, right? If you had traded around that, you would have been on the opposite side of the trade under both administrations, right? Because what we actually saw was that under Trump, you had the S&P 500, energy index, which is a bellwether for traditional energy, was down 40%, while the clean energy index was up nearly 300%. And then under Biden, you had traditional energy nearly doubling, and clean energy was down 50%, even though policy finally helped it, right, in a very historic way. Now, what ultimately drove this performance had everything to do with what was going on in the markets at the time, where interest rates were, the cost of capital, the global pandemic recovery, the shortage of traditional energy supplies during that recovery, and much less to do with whoever was in office and ultimately whatever they did during those times.
I think that's a very good lesson to us all, not to make too big a bet on any election outcome. Do you think that we're going to have increased volatility as we head towards election day? Given that it's a pretty uncertain outcome, do you think that volatility will actually go up as we head towards November?
I think perhaps. And I will say there is some seasonality that we do see in election years because elections create one thing that markets just don't like, and that's uncertainty, right? And uncertainty can lead to some to volatility perhaps being a little bit elevated heading into election day because people don't really know what to expect and what policy changes that might come after that. And so we do tend to see that. But I think the key message here, too, is that, equity markets are inherently volatile. That, unfortunately, is just kind of par for the course, being an investor. And what we find is that elections don't actually create that much of an additional headache on top of just what an average normal year in the markets may be. And, the data really does show this. One of our charts in our elections deck looks at realized volatility in the S&P 500 in election years versus non-election years. And what we find that on average, going back to like the 1950s, realized volatility is 16.5% in election years. That's a little bit higher than your average non-election year, which is 15.3%. But some of those election years were years like 2000, which saw the dot-com bubble and bust. Years like 2008, the global financial crisis, right? Major years, very volatile years, but for reasons that were largely outside of the kind of election season, right? Now, if you had taken out just those 2 years and their volatility associated with them, then you would see that volatility during election years versus non-election years, on average, it's pretty much the same. So while we might see some seasonality heading into election days, it's not something that investors need to be that worried about because it really doesn't lead to that much bigger of a headache for investors. And typically what we find is that after election day, really regardless of the result, once that uncertainty is cleared, markets then tend to perform better in those last few months of the year.
So summing it all up, what advice would you give investors then with regard to the election?
One of the earlier points I made was that, uncertainty can create opportunity for investors, right? But oftentimes, investors can also make their worst decisions during uncertain times. And politics can be that for many investors. I think you and I probably both share the same favorite slide when it comes to politics in our guide to the markets. That is page 68, which shows consumer confidence by political affiliation. And this makes one of the biggest potholes for investors abundantly clear when it comes to navigating investments during election years. Turns out how you feel about the state of the economy, probably the state of the investment environment, can be quite impacted by whether your political party is in the White House at the time. And we find that, during the Bush administration, surveyed Republicans felt much better about the state of the economy than Democrats did. Then under Obama, everyone felt pretty crummy at the beginning because we were in the global financial crisis, but surveyed Democrats still felt a little bit better, rosier about the economic outlook than surveyed Republicans. So this can really have a toll. But despite these swings in economic perceptions, market returns and economic performance during and through these various different political administrations or presidential administrations has been much more stable. So we don't want to let these things really be our kind of guiding force when it comes to navigating portfolios during this time. So the biggest piece of advice I would give to investors this year is, make sure you're voting your political preferences at the polls. Go out and vote. Do your civic duty, but do it at the polls, not in your investment portfolios, because we find that the best strategy for kind of navigating investments during this year is really just staying the course, making sure that you are staying in a portfolio that is catered towards your own long-term needs, that is allocated based on the market fundamentals, and much less about what we might see in November and what kind of comes after this. So don't let kind of uncertainty around elections be a guiding force or really be the reason why you get invested right now or not.
Thank you, Stephanie, for your insights today.
Thanks, David. Thanks for having me.
For our listeners, if you'd like to access our insights on the US and international elections this year, you can go to jpmam.com/insights. This also marks our last episode of the season. Thank you to everyone for tuning in. Please stay tuned for our next season, in which we will actually dive deeper into this very topic, elections. Or more specifically, what the outlook for trade, tariffs, immigration, regulation, and energy may be following the US presidential election. Until then, I invite you to check out my Notes in the Week Ahead podcast, where every Monday I share commentary on the latest in the markets and the economy to help you stay informed for the week ahead. For even more timely insights, you can also follow and subscribe to my content on LinkedIn. To all our viewers and listeners, thank you for tuning in today, and speak with you soon.